Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today, we're looking at CIFR mining.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave in the comment section below.
So let's get into the analysis.
And with this one, we really have two completely different stories clashing, right? Especially when you look at their recent financials.
It's pretty stark. You have this really bearish view that's totally anchored in the past.
In Q4 of 2024.
Exactly. In Q4 24, they reported an adjusted EBITDA loss of $14.2 million.
A loss. Okay. So that suggests, high costs, operational problems. Not a great look.
Not at all. But then the calendar flips to 2025, and it's a completely different company.
So what happened in Q1 that just threw that old narrative out the window?
The acceleration was just incredible. Revenue for Q1 hit $42.1 million.
Which is, what, 38% growth year over year?
Yeah.
Solid.
It is solid, but the real story, the point the bulls are all focused on, is the profitability jump, the adjusted EBITDA. It just soared to $18.7 million.
Wait, hold on. So we go from a $14 million loss in one quarter to an almost $19 million profit the very next.
A 163% increase year over year.
That's a massive swing. I mean, it's not just a small change. So the big question is this just them riding a higher Bitcoin price or something else going on under the hood?
That's the core question. And management's story, which is backed up by the numbers, is that this is structural. This is about efficiency.
Okay, so let's break that down. If it's not just the market, what did they actually do to create that kind of margin expansion so quickly?
Two main things, and they're both about cost, which is everything for a miner. First, they slashed their power cost per terahash by 42%.
42%. How?
By renegotiating their power purchase agreements, their PPAs. They locked in these really favorable fixed rates, especially in Nevada and Georgia.
Wow, okay, that's huge. Power is the biggest line item. What was the second driver?
Fleet modernization. It sounds technical, but it's simple. They upgraded their gear.
Better machines.
Much better.
Really?
62% of their equipment was migrated to newer generation ASICs. These machines are about 35% less energy intensive.
So they're using less power, and the power they are using costs them way less money.
It's that 1-2 punch. And that's what gave them the confidence to raise their forward guidance for the full year.
What are they guiding to now?
They're targeting an annual adjusted EBITDA of $90 to $105 million.
So they're basically saying Q1 was the new normal, not a fluke.
That's the message. But, the skeptics are still there.
Right, because you can't just ignore that Q4 loss, and then there was the CFO resigning unexpectedly back in January. That always raises eyebrows.
It definitely added some noise to the story right before these blowout Q1 numbers. But the company's response, really, is their balance sheet.
How's their liquidity?
It's very strong. They ended Q1 with $218 million in cash. And more importantly, they generated over $31 million in free cash flow in a single quarter.
And free cash flow is the real sign of health. So what are they doing with it?
A bit of both. They're returning some to shareholders. They repurchased 7.2 million shares.
Signaling they think the stock is cheap.
Exactly. And they're also reinvesting for growth. They spent about $19 million on 12,000 next-gen machines.
And what does that add to their capacity?
That's another 1.8 exahash per second that should come online later this year.
So they're using today's profits to buy tomorrow's scale.
Okay, let's shift to the competitive moat then. The argument is always about their cheap power.
It's just much, much cheaper than their rivals. Their average cost is around 3 cents per kilowatt hour.
And the industry average is?
The industry average is closer to 4.7 cents. So they have this 30 to 40% structural cost advantage baked in.
In a post-halving world, that's literally the difference between being profitable and going out of business. It is. But there's another moat, one that's a bit harder to quantify, the regulatory moat.
Explain that. What do you mean by that?
It's about getting permits. Building new data centers in the U.S. is a bureaucratic nightmare. It can take years.
Right.
CIFR already has fully approved permits for over 200 megawatts of expansion in Nevada and Georgia. The estimates say this puts them 12 to 16 months ahead of competitors who are still stuck in red tape.
So while everyone else is waiting, they're building. That's a huge head start.
It's a massive barrier to entry for anyone else. They have the land, the power, and the permits.
But let's play devil's advocate here. Isn't that a lot of concentration? I mean, 80% of their hash rate is in just 2 states.
That's the primary risk, for sure. It's a valid
Right.
point. A regulatory change in one of those states could really hurt them.
Or just a shift in those fixed-rate power agreements when they come up for renewal.
Mm-hmm.
Their low scale right now means they're very sensitive to that.
Absolutely. The concentration is the main operational headache for the bears, no doubt about it.
Okay, let's look at sentiment then. Are the big players, the institutions, buying this bull case?
The signals have been pretty strong recently. The biggest news was the partnership they announced with Block in April.
Right, formerly Square.
Yeah. They're dedicating 15% of their mining capacity to Block's new institutional product.
I love that move. It basically takes a chunk of their revenue out of the volatile crypto market and turns it into a stable, fixed income stream.
It's a great hedge. It's like selling guaranteed uptime to a huge, stable customer. And insiders seem to agree.
What's the insider activity been like?
We saw the highest level of insider buying in 3 years. The CEO and CFO together bought about 1.4 million shares.
Wow, for how much?
Just over $2 million. You just don't see insiders making buys like that unless they believe their stock is seriously undervalued.
And are institutions following suit?
We've seen some big funds building positions, yeah. Cathay Financial boosted its stake in Q1, and Renaissance Capital, the big quant fund, they upped their stake by 45%.
So it's moving beyond just the retail crypto crowd. Okay, what about near-term catalysts? What should people be watching for in the next couple of months?
There are 3 big things on the calendar. First, Q2 earnings, expected around May 14th. The street is looking for about $48 million in revenue.
If they beat that, it proves Q1 wasn't a fluke.
Right. Then, on May 21st, they have their Investor Day.
And what's expected there?
The chatter is they're launching a new product called the Crypto Mining Yield Platform. It signals a move into more value-add services for institutions beyond just mining.
More like a tech infrastructure company, less like a simple commodity producer.
That's the idea. And the third catalyst is just the macro environment.
The post-halving window.
Yep. We're in that 90 to 120-day period where historically miners that survived the halving tend to see their multiples expand a lot.
Now we have to address the rumors. There's always speculative chatter around a stock like this.
And it is so important to treat it as just that chatter. There are these persistent rumors about a deal with Microsoft to host AI workloads in their data centers.
Leveraging their cheap power. It's a great story, but
It's pure speculation right now. Same with the rumors about a potential asset sale to a Canadian PE firm. They're just whispers. You have to focus on what's confirmed, like the Block deal.
got it. And really quickly on the technicals, what's the chart look like?
The chart's actually been pretty constructive. It confirmed a golden cross back in March, which is a long-term bullish signal, and it broke cleanly above a key resistance level at $1.64.
So, with all that said, what's the #1 risk that's still on the table?
It's still Bitcoin price volatility. I mean, at the end of the day, they're still a miner. About 45% of their revenue is directly tied to the price of Bitcoin.
So if BTC drops below, say, 55K, that's going to hurt their earnings
It will definitely impact them, but they have tried to mitigate that.
with the hedging strategy.
Right. 60% of their planned 2025 production is already hedged with forward contracts.
At what prices?
The range is between $61,000 and $68,000. So even if the price crashes tomorrow, a huge chunk of their revenue for the year is already locked in at a profitable level. So it all comes back to the central question. The market seems to be underpricing this asset compared to its peers. It's trading at a discount. And Q1 proved that the operational efficiency from low power costs is very real. The dilemma for investors is, do you view this as just another high-risk bet on Bitcoin, or is it becoming a sustainable U.S. infrastructure business?
That's the question that will determine where the stock goes from here. If you found this analysis useful and want to stay ahead of the curve on fast-moving stocks, make sure you subscribe to Smart Wealth with Joshua.